I'm going to go ahead and take a little break here, bring on Lowell. I met with Lowell about a year ago. I was thinking back last October, November.
It was raining.
And raining heavily, and we went out to Starbucks, and I said, hey, we're really looking to build an exit advisory team, and you'll get a chance to hear Lowell's background in just a moment. But step forward. He said, yep, let's do it. I'll join as a member. I'll be a part. I'll be supportive. And it's meant a lot to us, meant a lot to me. So thank you for your support as we've gotten started. And very pleased to turn it over to Lowell here to run through selling your startup and a little bit of his background, maybe his perspective on working with angels and trying to get exits and kind of what you've seen. So I'll pass over the mic, and we'll get it going here.
Thank you, Nathan. Thank you, everyone, for joining today. I know your time is valuable. I'm going to talk through some of the considerations of selling your company, and I've got a little bit of a different perspective than a lot of the advisors that I know. And it really comes from my experience on the buying side. I've bought a lot of companies along the way. So I was part of a Fortune 500 company for about 15 years. I sat next to Corp Dev when I was Global VP of Sales. And so I understand Fortune 500 company buys, kind of what that process looks like, what Corp Dev's role is, what product's role is, finance, the board, the CEO. And then I was I left that as a part of several startups, two that did fairly well. We did a number of acquisitions along the way, fairly small. Another one, we did a couple of significant acquisitions as well. I'm like a recovering executive. It's kind of how I got in the M&A space, completely by accident. And so chief operating officer, and we bought companies, a couple in the U.S. We're based in Europe, some in Asia Pacific as well. And then I actually co-founded a company that was a very minor success. A couple companies got fairly significant, was fairly small, and I really looked at my experience buying companies and my sales background and thought I could run the process myself and sell my own company, which I did. Successfully sold in 2016. One of our investors asked me to run the same process for one of their other portfolio companies, which I did, and I realized that there was an opportunity in the marketplace for companies, it's much like baseball, that are not home runs, but are singles, doubles, and triples. We talked about that a little bit earlier. And if you look at the average IT exit last year, it was $462 million, so it's pretty large. But the median was $29 million. So 50% of software company exits were less than $29 million. And many of them are in the 5, 10, 15. So that's kind of the bread and butter. I'll talk a little bit about why those are sometimes not as interesting to the mid-market investment banks. That's why I opened up a boutique M&A firm. Transaction advising. So additionally, I'm an angel investor. I do a lot of mentoring globally with a number of different groups. I sit on boards. I'm an advisor. So I kind of know what it's like to sit in everyone's shoes. Everyone's situation is a little bit unique, but I've got some perspective. The first question I'll ask when I talk to an entrepreneur or a board member is why sell? There are a lot of different reasons why. There are a lot of very good reasons why. And it's rarely a black and white answer. But accelerating adoption is a great reason why. Oftentimes, cash-strapped startups, they've proven product market fit, they've got some customers, they've got some linear growth, but they can't quite hit that hockey stick growth. Oftentimes, that same product inside of a company that has a massive installed base, I call them adjacent space products. So if it's a product, if you sell to SMB, so small business, tough market to sell into. If a company that has 200,000 SMBs as customers already, if they were to simply introduce your product, if they picked it up as an adjacent space product, get 5 or 10% adoption, it could be a pretty significant product. So that happens all the time. Leveraging the acquirer's infrastructure, so they may have 2,000 salespeople and a large client services team globally that can accelerate the growth rate of your company. Macroeconomic concerns, we've been in a long bull market. It's been 10 years now. Are you willing to bet it's going to go another 10 years? As long as I have. When it's too good to be true, it usually is, and something unforeseen happens. So even if your company does well at a macroeconomic level, if you go back to 2007, cash was plentiful like it was today. A year later, no one could raise money. Private equity dried up, like literally within weeks once Lehman died. So will it happen again? I don't know. This may continue for another 10 years. But those are things to factor in. The investor's desire for a return. I've been an angel investor for 7 years. My IRR looks great on paper. I've gotten 3 or 4% back. So it looks great. It makes me feel good when I look at it. But at some point, it'd be nice to see some checks come back. Additionally, founders, I don't think founders do it for the money. There are other things they could do for money. But at some point, there's often pressure from the family, or often, 2-3 years of eating ramen noodles. It's nice to put some money back in the bank. And founders fatigue. There's a magic window somewhere between 3 and 7 years. You identify a problem, you identify a solution, you build it, you get a great team, you find some clients. But at some point, if it's not but once you know the unknowable, once you've gone in there, it's often you've applied every brain cell that you've got to hit that hockey stick. When you realize that you can't do it, you've tried everything that you can feel trapped in this linear growth company. It's still a good company, you've got good clients, but it's no longer exciting. Also, entrepreneurs by nature are a little bit ADD, and they like exciting, new, creative things. And even as a company becomes successful, it becomes more operations driven. It's not as exciting, it's not as creative. And there are people who love that stage. So often it's better for the startup environment for those founders to leave and start up something new. In many ways, it can be a waste of their talents and energy to spend the next 10 years slogging away to try to. And at the end of the day, life's too short to do things that aren't super exciting. So in that 3 to 7 year window, I met with a couple recently. Their companies were 10 years old, and they'll often tell me over coffee or beer. At some point, they'll just say, "I'm done. I want out. I don't want to do this anymore." And that's fine, and it's fair. But often they've taken on money. I do this as well. You've taken on money. You've got an obligation to your investors. You want to stick it out for them, but at some point it may be time to get out. And then to mitigate risk. So how much is it worth? Everyone wants to know that. At the end of the day, it's worth what someone will pay for it. I can tell you the first early stage company I was a part of, it was a pretty good exit, but when they first bid was $40 million. They eventually sold it for $110 million. They created $70 million in equity for the investors and the founders simply because there was competition. They were able to drive the price up. But there are some median metrics that you can look at. Part of it depends, are you in a high growth business? Are you profitable? Private equity plays heavily. There are financial and there are strategic buyers. Strategics are other corporations, but many of those are owned by private equity. So at some point, the financial metrics come into play. We'll talk more about that later. But if I look at SaaS companies, on the revenue side, the median is like 5.3 last year. So 5.3 times revenue is a pretty good number. But somewhere as low as 1, somewhere as high as 20. It depends. How big is the market? The market potential. How difficult is it to replicate? Are you unique? Are there 2 or 3 companies that do what you do, or are there 4,000 companies in what else? EBITDA, this is primarily private equity they buy, but typically smaller exits. There aren't very many private equity firms that want to buy smaller firms unless it's a bolt-on. And if it's a bolt-on, they'll play sometimes a little bit different metrics. But what I encourage everyone to do, what changes the game more than anything, and I'll talk about the hill of resistance, is the fear of losing something, and the fear of losing something to a competitor far outweighs the desire to have something. So fear is a very, very powerful motivator. Company stage matters a lot. Pre-revenue, it's tough, unless you really got some unique IP, and there are some things. I'm primarily tech and software. There's some things that come out of UW where you've got some great IP behind it, where I think it's probably very saleable, so the companies can scale it. A lot of early revenue company, this is kind of the sweet spot, what we see in Northwest. So companies with $500,000 to $2 million in revenue. So it's real revenue, it's recurring, but it's kind of a tough place to be. Insignificant revenue, I can talk about that. Those are easier. If you've got 10, 20, 30, 40 million in revenue, those companies are actually much easier to sell. There are a lot of buyers out there. Publicly traded companies that need the revenue and the earnings, and then private equity firms that will borrow money to buy your company. The multiples get higher as well. So even if your EBITDA positive cash flow as a percentage is the same, if you're $1 million company, a $5 million company, 25, 50, 100, 200, the multiples get higher. So you'll see a lot of software companies in the $100 to $200 million range. with high multiples. And I'll see a lot of entrepreneurs with 500,000 in revenue, and they apply the same multiple, and I said, possible, but it's not likely. So what do acquirers buy? And this is interesting to understand. There's the comment out there that companies are bought, they're not sold. And I think it's important to understand. I'm not sure what the original intent behind that was. I think sometimes people feel like if I build a great company, someone will call on me. And I'll talk about that in a minute. I call it like an unsolicited offer. And typically, if you just take that, guarantee you're not getting the best deal. There was a company that sold in Seattle a couple months ago. I won't say who the company was. Unsolicited offer, $7.5 million. They weren't quite sure what they wanted to do. They ran a very quick process. They doubled the price to $15 million, sold it to a different company. Had they taken, they were pretty happy with the initial offer. But so back to what do acquirers buy? There are really kind of three different buckets. So team, skills, and talent. So if you've got a media company that wants to add a technology product, they struggle to hire the right talent. Tech people don't want to work for a media company. So they may actually buy the team. So a deal that closed in June, local company, Glimpse It, was sold to Forrester. They wanted artificial intelligence, machine learning as it's applied to data. It's a big data company. So they bought that company and the product that went along with it. Sometimes it's the technology, it's the product, intellectual property is really what they're looking for. And then they can scale it. A much larger organization can roll it out to their customer base and can scale it pretty quickly. The third bucket, the far left bucket can sometimes be viewed as an acqui-hire as well. Not always, and it's not a bad way to go for some companies. It's better than dying. And sometimes they'll pay a premium depending on what you do. You can actually get a decent exit there depending on how much money you've raised. Far right, so this comes back to publicly traded companies. 95% of the CEOs I talk to on the buyer side are struggling to hit their growth objectives on the top line for revenue and for profitability. So they're always looking for, they're struggling to grow organically enough. And so they're always looking to bolt on other acquisitions where the revenue is accretive and it's significant. But you can do the math. If they have to grow 10% annually, if it's a $10 billion company, they don't care about a $5 million acquisition, at least not for the revenue purposes. But if it's a $100 million company, a $5 million acquisition can be significant. It can help the CEO hit their numbers. So often it's market share. When I was a part of Toluna, we bought 2 companies in the U.S. I mentioned that. The company may be strong in North America. They want to branch out into Europe or Asia. A great way to do that is buy a company that's on the ground. In revenue, in EBITDA, if I oversimplify it in some ways to financial buyers, it's your company's like a bond. Regardless of what you do in the past that you put into it, at some point you generate revenue and you generate a return, not unlike a bond does. And that's some of the metrics that get applied to that. So that's what they buy, but why do they buy? And there's kind of a quadrant in here. Typically, it's revenue growth or it's consolidation and operational efficiency. So on the revenue growth side, they may want new products to expand on the set that they've got today to drive new revenue. I mentioned geographic expansion. They may have teams with different domain expertise. So skills that they don't have in-house and they don't even know how to hire those, they can hire teams that are pretty strong. Consolidation, this is where you see companies will buy out a competitor. The large companies that you see come together and they'll take out a lot of cost. That's on the operational efficiency side. Revenue growth, this would be different regions around the world. And then on the consolidation side, where you see mature companies will buy each other and take out a fair amount of cost. And then technology is kind of the magic box that can drive expansion as well as operational efficiency. So financial buyers, this is interesting. Last year, the majority of PE, so private equity, there's a world is flush with private equity money today. And what's good for smaller exits is that many of the private equity-owned companies are focused on bolt-ons to increase the value of, I'll call it the big fish that they bought. So they may buy a $100 million company, and they're very receptive to smaller bolt-ons that will increase functionality, revenue. So this is the process. Nathan talked about this a little bit. It's pretty straightforward. I wrote a blog. If someone wants to do it themselves, we'll walk people through it. But the planning and the research. So it's really important to look at target acquirers and map out who they all might be. I've got some advice for companies early on, so I won't go to that right now. The messaging is key. If you're going to reach out to the CEO of corporate development, you only get one chance to make the first impression. It's important to get that messaging right. And the messaging is less about what you do as a company. It's more understanding why that company would care about acquiring your company. Because the reality is they don't care about me, they don't care about you, they don't care about your company. They care about their problems. To the extent you can do research on the target acquirer, understand what their strategy is, understand how what you do fits into their strategy, they're all ears. And they appreciate the help. They'll thank you for helping them solve their problems because they don't have all the answers. So the messaging is key for that. There's a lot of research that goes behind that. Making sure it's concise, the classic message. I apologize for the length of my letter. I didn't have time to write a short one. Getting that messaging short and concise in all marketing is critical, especially when you're selling your company. Data room, I encourage people to have your data room organized from the start when you build your business. It's things like IP assignment, confidentiality. If three of us start up a company tomorrow, things are kind of loose. You're just trying to get this product built. But the reality is if you've got 2 to 3 people that don't sign these, and you're selling the company 6 years later, it turns out people work for a year without this IP assignment. They may have legal rights to that, the code. It can create as a minimum a lot of stress, and it can kill a deal if you can't wrap up those loose ends. Particularly, often founders don't remain friends 7 years later. It's pretty intense. And if they leave on bad terms, it can make for a very difficult close. So part of that's kind of a data room clean. Part of it's actually creating it, so all the different documents. And in the exit book, you'll see there's a kind of a sample of what you need to keep. Basic employee agreements, IP assignment. Got someone who's organized, put them in charge of that. It's kind of my advice. Board approval. The board needs to be on board. There's typically approvals. M&A attorney. An M&A advisor can provide advice and counsel and do a lot of the work through the process. But along the way, particularly when you get to the LOI and the purchase agreement, your attorney will be talking to their attorney. And they can either make the deal happen or they can get sideways with each other and they can cause a deal to not go together. And oftentimes you'll be making statements in legal documents that will make you very uncomfortable. And it's good to have a lawyer that you trust and say, should I include this or not? There are pros and cons to that. And they can gauge the risk and say, and you want somebody who's done M&A. So there are a lot of great attorneys out there. It's like if you blow out your ACL, you want to go to a doctor that does ACL reconstruction, and they're probably pretty good. If they do it once a year, if they're the best doc in the world and they only do it once a year, probably not who you want to go to. Same thing with M&A attorneys. You want someone that's seen the movie 20 or 30 times before and can say, that's not a big deal. This happens all the time. We'll just do X, Y, and Z. So the outreach, you want to finalize your messaging. Typically there's an executive summary, and there's a longer deck that goes into more detail. Typically the longer deck you only share once you're behind an NDA. There's the outreach, follow-up, introduce the CEOs, then you engage, you have discussions, do demo, do light diligence. I can tell you right now, the light diligence will feel like heavy diligence, and by the time you get to an LOI, you'll feel like they've already done all the due diligence. And then the diligence really starts, where they want, if you've ever leased a copier, they want to see they want a copy of everything you've ever signed. But good to be on that side. The LOI, the term sheet is critical. Those are the big terms. I call that the short sheet. So it's 2 or 3 pages long, and it's got the important elements in there. The deal doesn't get any better once you sign a term sheet. So you want to negotiate. If you're going to stay on for a year or 2 years or 3 years, employment agreements are a part of that. What's my salary going to be? What's my bonus? What's my retention bonus going to be? Smaller exits, the retention bonuses can be a significant part of the compensation of what you get from your company. The benefit of an M&A advisor is, and I've done this, I do it now, and I didn't have that when I sold my company. M&A advisor can be the tough person to get top dollar for your salary bonus, retention bonus, and then you're still clean. You don't burn all your capital because you're going to have to work for them once the company's sold. Once that's agreed to, and this is more traumatic than you think it will be to get it done, the due diligence starts, and they'll work on the purchase agreement. Typically, this is done in-house on the buyer side. Once it's agreed to, they'll hand that 2 or 3 page document to an outside law firm that's not been a party to any of the conversations, and they'll create a 100 to 200 page legal document that when you first see it, often feels like you're kicked in the stomach because it's not what you've been talking about. And that's okay, that's normal. So you have to highlight what's important, what's not, and make all the corrections. But I know people I've worked with have walked away from a deal because when they first saw that this is awful, they felt it was a personal affront. And don't get me wrong, buyers are always trying to get the best deal. They will lowball you. They will pay you nothing if they can. They'll ask for outrageous terms. So it's good to have, and also realize buyers are typically, if they have corp dev, they're professional at what they do. This is what they do all day, every week for years and years and years. Usually when you're selling your company, you've never done it before, so you don't even know what you don't know. So it's an unfair advantage, and that's where you want someone on your side who can say, that's ridiculous. Things like one of the line items will be in there, they want your bank account, your cash, your accounts receivable, and you keep accounts payable. Well, you may not really think much about that, but if you've got $200,000 in cash and accounts receivable are $300,000 and accounts payable are about $200,000, that's $700,000 swing. That if you don't know how to negotiate that they will take out of your pocket and they'll put in theirs. I've been on the buying side. If you ask for it, and you're not coached to respond, you'll get more out of the deal than the top line number. Additionally, the structure matters a lot. Talk about what's my company worth. Is it worth $5 million? $5 million can mean a lot of different things. If it's $5 million cash up front, it's really easy to understand. If it's $5 million in private stock that may or may not ever sell, it's a very different story. If it's $1 million in cash up front and $1 million a year for 4 years, tied to some forecast that you gave them, or earnings, and you have zero control day one once you're purchased, that $4 million is extremely risky. It may only be a $1 million deal. So entrepreneurs are often focused on how much is it worth. They want like a number. Is it 5? Is it 10? Could we get 30 or 40? Yeah, you can get 40, but it may only be 5 up front. You've got 35 tied to hitting some objectives that may or may not happen. So structure really means more than structure will drive the likelihood of what the actual number will be. So this is what I talk about. Companies are bought. The buying process is significant. It's not trivial to spend millions of dollars of a company's money when you've got a business to run. So it doesn't mean they'll come. They might reach out to you. That usually doesn't happen. I proactively reached out to companies and bought them. It's usually when I got the best deal on the buying side. I had companies reach out to me. Opportunistically, it wasn't on our radar. This company is for sale. We said, let's drop everything. This is a pretty good opportunity. Well, guess what? They reached out every one of our competitors as well, and the price went way up. Great for them, wasn't great for us. But you have to make so. I take what I've learned on the buying side and realize that it's less about selling. If I want to sell my car, everyone here has probably got a car. There are probably thousands of buyers in Seattle that want your car. They don't really care about you, but that they just want your car. So you can sell it. You put it up for sale. Companies, there are a finite number of buyers for your company. So you don't just put it up for sale. There's no multiple listing service fee. Well, actually, there kind of is. There are brokers that will list them. But for tech companies to really find the right strategic fit, you really have to walk the buyer through the buying process. You have to paint a picture for them of what success might look like with your product, your team, and whatever that they've got to offer. And what I found is oftentimes when you first, this is the side where they're resisting. This is where they wake up and they envision their future with you and your team as a part of it. They get farther down. This is where they start to worry that one of their competitors is going to steal this good idea and take all those good happy thoughts that they have. But then there's also this point where if you wait too long, as excited as they get, as scared as they get, that will pass. There's a period of time where they're excited and you can negotiate, and then they move on, or something else more interesting comes in. There's a fatigue in the negotiation on both sides that can happen. But what I try to tell people is typically when you reach out, there are all these reasons why they wouldn't buy. Well, what about this and what about that? So understanding what all of those hurdles and obstacles are, you working with them until you can get them over the hump of the hill where all of a sudden they're excited about the deal. But initially, you'll often get a fair amount of resistance in the first couple of months in conversations with people. Some will just say no, and then you're gone. Some will say, yes, it's interesting. but what about this and what about that and what's the tech stack and all the different things that come up. All these, as they start checking off the boxes, they start selling themselves on why they need to have it. So advice to earlier stage companies. Talked about some of these. Buying a business is not unlike getting married. If I represent a company, well, actually the buyer. So my company from 7 years ago that we sold in 2016, the buyer didn't know who we were. So the founder had never heard of us before. So it took a long time for them to get to know us. Had I done business with them for years beforehand, that process would have been much shorter. So if I reach out to the CEO and talk about why they should buy this company, and he calls Max, who's a product manager, and he's been working with Choreo for 5 years, and said, these guys are awesome. Like, this is great. And it makes that process much faster. The other thing I would, reach out to, take some time, think of all the potential companies that might buy your company, figure out who the decision makers would be. If they have a corp dev function, figure out who they are. I wouldn't waste a lot of time with them. If they have a CEO, now granted, if it's right now, but if it's GE or a big company, the CEO probably won't talk to you. But a lot of, I'm surprised there are a lot of $1 billion, $2-3 billion companies that will talk to you. And so it's good. Reach out to them on LinkedIn. Just say hi. Here's what we do. Be interested in talking to you. Not that you're trying to sell the company. Might be a chance to work together. Just get on their radar so they know who you are. If you go to conferences and they're there, let them know. Reach out. Let them know you want to meet with them. If they don't meet with you, if you're kind of branding yourself every time you reach out to them. I talked about the data room. It's a pain in the ass. It's not fun. I don't like it. But if you're organized, create that now. If you're not, if you've got someone who is organized, have them create it. It's just a good practice to have. There's no downside to it. Non-competes, I talked about that. IP assignment, missing documents, you're going to have to clean those up. And start early. What is hard for me sometimes, companies will come and they'll say, hey, I need some help on some of my companies. Okay. But yeah, we have 3 months of cash and we're dead. It's like, happen. It's like, I mean, you could try. I'll never say don't try, but you can find out who's interested in 3 months. But even once someone says, I want to buy your company, then you start talking about the LOI. This would be short. It's often a month, depending on how far you want to go with it. In the purchase agreement, 100-page document with 1,000 red lines in it. I mean, it just takes a long time to grind through the details. So it takes 2 to 3 months to find the right buyer. It takes at least 2 to 3 months to kind of work through the paperwork. Typically, some go faster, some take longer. All right, I think I'm past my time. Talked about unsolicited offer. If you get one, often people feel badly about going out and shopping it because we like these guys. You should, one, I think you should. You'll probably make more money. And two, you've actually got a fiduciary responsibility to your shareholders to get the maximum price. If you haven't shopped it, you're potentially at risk of not having done the right thing there. I think the risk is low in the Northwest, but it is true. Now, who is they? Often the director of product will say, hey, we should buy you guys. And I'm not going to say, hey, these guys want to buy me. So, well, who's they? It's like, wow. Product manager. It's like, well, buy your company. Like the CEO signs off on all these things. I talked about structure. Buyers are expert. They're always really nice, generally really nice, but they're trying to get the best deal for themselves. I'm like 10 minutes over. Questions?
All right, excellent. Thanks, Lowell.
Yes.
We'll keep it going here. We got about 20 minutes for Q&A here, so why don't you just hang up here with me, and we'll see what questions we have from the audience. So let's go ahead and zoom out here, and if you have questions, please submit those in the question window or the attendee chat. Looks like we still got about 15 people with us here. So we'll start off. Any questions in the room here? We'll just go around. Do you guys have any questions for Lowell? All right. Any feedback? Any questions?
Do you see in the future there might be a growth for listings by these sellers, basically kind of streamline the process, make it a little small?
Yeah.
buy and sell without seeking advice? Do you see, you know, in the future, platforms popping up more for
A number of companies have tried, a lot of tech-enabled, a lot of software companies have actually tried to build a marketplace, because part of the problem is it's very opaque, right? It's hard to know. I mean, it's similar with angel investment, right? I mean, it's hard to know. That's why join groups. It's hard to know where the deals are, where the deal flow is. And if you're an entrepreneur, it's hard to know where the money is, like where are the angels? They're all over the place, but they're hard to find each other. So there are companies, and they've really struggled to be successful for a couple different reasons. Part of it is a lot of companies don't necessarily want to broadcast that I'm for sale. They don't want to post it to the world that, hey, because it can give away some of their client base. There are sites out there today, though. I forget what they're called. I can find a couple of those where you'll see typically not the best companies. I don't want to random. There a lot of traditional companies. Sometimes they'll do that. If you're a pharmacy, you do a couple $1 million a year in business. Probably not that big of a deal if people know. But the more sophisticated, the more complex companies, the corp dev for Forrester is not combing through websites of companies that are listed like the. I think it's possible. Like I say, a lot of it is opaque. A lot of it is part of it is the awareness, and part of it is wisdom and the guidance and the advice. It's overwhelming. And most CEOs, you build a company, if it's successful enough to sell, you think, I've been through a lot. How hard can this be? It's every CEO in the end. If you told me that, I had no idea. But when you go through it, it can be even good exits can be.
Well, a lot of the, companies are selling a product. They know who's buying their product. They're talking to their customers. Maybe they know distributors. Maybe they know competitors, producers of other products. But what percentage of the universe of the companies that may buy them is kind of the people that the company would naturally be interacting with versus kind of sitting down and trying to look at a much bigger universe of potential acquirers, and what is the potential, from your experience looking at lots of deals, how oftentimes is the acquire kind of a vertical integration or kind of somebody in the realm within the company's current operating, or is it somebody who wouldn't have been on the normal radar screen that they thought of unless they would have, gone through a process and really thought through kind of a much larger universe of potential acquirers.
You've got your usual suspects, but I'd say probably about a third of the time, often as many as half of the companies we'll reach out to were not on the initial of the entrepreneur. Even though they live in that industry, you kind of get blinders. But often it will be companies. If you look at who your customer is, like who's the buyer, and then you look at who else sells to those buyers, and it actually may be a significantly different product. But if they have the same customer base, they can take your product and introduce it to all of their existing customers and generate a fair amount of revenue. Okay. One company is like GoDaddy is one that people think of like domain names, but they sell domain names to typically small businesses. Small businesses buy hundreds of other SaaS products. So GoDaddy is our company that rolls up a lot of other SaaS companies, and a lot of companies would say, I never would have thought of them as someone that could roll up my SaaS company. But it's because of who your target market is. You're selling to the same potential buyer.
Excellent. So Hunter has a question. Any strategy for positioning in a partnership towards an exit with a bigger partner company?
Kind of a broad question. I highly encourage partnerships with potential acquirers. There's almost no downside unless it doesn't go well. If the partnership doesn't go well and they don't like the product, then you've got a bigger problem anyway.
Yeah.
But if you can, that's why I call it, it's like starting to date before they buy the company. But if they've got a track record, someone internally that uses it and there's a dependency on it, they will get it. It's a great way to go. And that's why I think it's an important part of reaching out to potential acquirers if they are legitimate partners. Try to get those partnerships. The other thing I'll say is part of running a process, typically, because I'll reach out to the CEO level, and often companies that say, well, we're not in a position to acquire for whatever reason, but I like the product, we're going to use it. Major partnerships actually roll out of running the process as a good but unanticipated
kind of the initial mindset definitely needs to be, who could be a corporate partner for us? That's one list. Pursuing those, generating discussions, trying to get some deals going from a general biz dev sense, and then try to extrapolate even further and try to think about whoever else might be able to, have a common customer base for my product, even if they may be selling something totally different than what I would think that they would want to buy, but
Right.
has a lot of customers that would also want my product.
Even the partners, it's often a different person. Maybe a VP product, different titles, more on the operational side that you'll partner with. And when it comes to corp dev or acquisition discussion, that's typically a higher level discussion, so they may not. So I wouldn't always expect the person that's buying your product when they call up and say, hey, you should buy my company. It's not their call. They might be a good coach, but often they're not even involved in acquisition.
Totally different departments, so you do have to kind of map out the corporate chain and be more visible. Because the acquisitions may be handled out in New York, whereas the purchasing department may be in Los Angeles or something, and they may not even talk to each other.
Most companies they have a corporate strategy, and acquisition is a part of that. So knowing what their strategy is and does this fit into it, or how could it fit into it, is critical just to get their time. Yeah.
Other questions from the group here? Brianna or Max, do you guys have any questions? Or any other questions online? We've got time for a couple more. If anybody else would like to submit one, just let us know. Oh, we already read that one off from Hunter. Any questions, Brianna?
Well, what is the biggest hurdle for the companies that we're investing in to be able to see an exit? So, for instance, like Nathan and I, we have about 25 companies in our personal portfolio. And the first check I ever wrote was, 12 years ago for a company. And the company is definitely on the downward curve. And they're looking to raise more capital and kind of pivot. They brought in a new CEO. I'm still waiting to meet the new CEO. Have put out my disgruntledness around the fact that the CEO hasn't said hello to the new shareholders that helped them get to this stage. And basically a person on the board told me that I need to be patient for 6 more years. So you're telling me that I have to wait 18 years to see a return on a company that actually does, it does well in revenue, and the EBITDA is okay, but to actually see a return that I want. So it's I'm looking at these companies and I'm looking at what is the hurdles that we face in the Seattle area to drive more exits? Is it the way we speak? Is it the way we talk about it? How can we work with these companies early on? I have so many questions about this, so that's why I'm sitting here pondering and thinking. Because I coach these companies, I coach our investors. We want returns. And I finally have started telling these entrepreneurs that it's not philanthropy.
Yeah.
I'm not donating money to you. I am investing in you because I like the idea, I like the product, I want to fund the future. I also want to make money.
Yeah.
So how do we bridge that?
Probably a lot of different. It's probably case specific. They're all a little bit different. Typically you want to have at least $1 million a year in revenue. Some positive cash flow is good. I can't tell you how many companies say, wow, we're minus 15% cash flow, but if this, this, and this. I said, look, buyers hear all the time, and you might be right, but from hundreds of companies that are losing money, they just don't know if, at scale, if they'll make money. So it's a big hurdle. So if you're positive cash flow at all, it's easier to talk about how you can be even more positive cash flow, but if you're burning money, it's a tough place to be. And part of it is, most people just don't know what to do if they're going to sell a company. They literally just, they know what they do. They're struggling to get better and grow and make things happen. Most entrepreneurs have not been through an exit. They don't know how to get started, or how it would work, or where to go, or would someone buy us, or who would buy us.
But then you look at Amazon, and you look at Tesla before the SEC said they're going to file a lawsuit. But you look at their market cap, you look at what they have, and they bleed money.
Yeah.
It's not there. So is this a new effect that companies are going through, that they, are just burning capital and not actually creating any profitability, but their market cap keeps increasing? And
they're more anecdotal, the Bay Area hyper-growth companies. And if you're growing, 200% per month, you probably don't have to make money. But guess what? Most don't. Even if you're going 60% annually, it's pretty good. But most companies, most buyers, they want revenue, and they want profitability, or a clear path to it. They have to believe it. You it's just a lot harder to convince someone there's a path if it's not profitable. Like, hey, if you spent 7 years, you can't make this profitable, why could we? And maybe you can. You can paint a picture. Oftentimes there are very good reasons why. You just need a little bit more scale. You've got this fixed cost of software, infinitely scalable, you just need more revenue. I just can't tell you how often they hear that. They're just like, yeah, okay, here's another one. So very solid if you can bump profitability.
And that was my experience with one company we were working with. They were selling this last year, and they had a lot of high-cost engineers on staff that was causing them to lose money. And that was, as I evaluated the company, I'm like, look, you got to figure out how to drive this engineering cost down. This is crazy what you're paying. And as soon as they cut the staff and outsourced a bunch of it, boom, they're profitable. Now they're making $50, $100K a month. And just the whole company's culture and perception has just completely shifted because of that, and their feeling about themselves, now they're profitable. And so I think just getting out of that rut of losing money and making the hard choices and maybe having to sacrifice some of the people that have been around for a while to cut costs and understand what do you need to do to be profitable. And then, banks look at you a lot differently. Everybody in finance looks at you differently and be a profitable company. So I think maybe the angel coaching 101 here is to, number one, figure out a way to meet with your portfolio companies, have a frank discussion, have a short checklist of questions we're trying to get the answers of, including, profitability potential, some talk around the exit strategy, and just, again, try to get the perception going a little bit of a different direction. And so as we're trying to help our angels that have a lot of coats in their closet and are trying to figure out how to, swap some stuff out, I think that'll be part of this process within the handbook, help our angels be able to have conversations with their CEOs and figure out, what is the best next step to get the company perhaps to be able to talk to Lowell and other exit advisors and what they want. There's that expectation around exit and time frame, but I do agree with you. I think getting profitable is one of the healthiest things any company could do if they want to sell.
Well, or you don't have to. At that point, you're making money. You're not going to die. I mean, in theory, you shouldn't die. You can self-sustain. Sometimes for VC, raising VC money, hyper growth, they will invest in it. But when you're selling, again, if it's hyper growth, you're one of those superstars. But most of these companies we're talking about aren't. And I think a lot of people get jaded. I talk to a lot of entrepreneurs that say, "No, we really need growth. Growth matters more than anything." I say, "I'm telling you, you can get that hyper growth. You're right. But guess what? You're not there right now, and trying to get from 15 to 20% growth versus profitability, they don't care 15 to 20%.
Yeah, what is a hyper growth benchmark? And obviously, it's not 15 or 20%. It really needs to be some substantial amount more than that. Do you have kind of a benchmark for that? Where are you in the hyper growth
there, and
phase?
I'd have to kind of research it. I think it's like 60% month over month. It's where it takes off like wildfire.
Yeah.
Where you throw it out there and you get that viral adoption, which rarely happens.
Yeah.
Right.
So you know it when you're in it, and if you have questions about it,
you've been a part of it. It's pretty exciting.
And those are the ones we're looking for in our angel portfolio that we want to be doubling down on and really supporting that hyper growth and that funding plan. But for a lot of the companies where the growth rate is going to nominalize itself out, that's when we got to have these discussions and really understand how important is profitability versus growth as that rate's changing and look at different.
The simplest answer I'd give, more than a number, would be if it's nonlinear growth. If it's linear growth, you're kind of stuck there. If the rate of growth is accelerating, not matter as much if it continues the flat curve. Not a bad business. Those are great businesses, actually. That's what most businesses are that sell for less than $29 million.
Yeah.
But if you're losing money, you eliminate a lot of potential buyers off the bat. They won't even look at it.
And that's really quarter-to-quarter revenue number. What is the growth rate of that quarter-to-quarter revenue number, and is that growth rate accelerating based on the capital that's been invested in the plan? Acquisition costs for customers going down a bit, and there's a viral effect.
It means you get smarter. Things are working better.
Yeah. Or is it more of a good growth rate, but it's not picking up exponentially, but can you demonstrate that profitability? Well, I really appreciate you guys being here, everybody being here for our inaugural exit training. Time for another question if we have one more here, but otherwise we can go ahead and wrap up. Yeah, go ahead and speak up. Yeah. Yeah.
Startups, they have a burn rate.
Yep.
Rather than when they have that big inflection.
That's where I early on I kind of qualified, biotech, a lot of things like UW, where they've got, if you've got the cure to cancer and you're burning money, they'll buy that. They incubate it, you get through all the different. I am not an expert in that space. Anything I would say would be anecdotal from what I see and what I hear, but it is very different. Yes.
So the question was about biotech, life science companies, which is about half of what we do is in life science, and the physics in that exit market are just different. It's very data-driven, and that has a whole other set of exit advisors involved in those markets that understand that vis-a-vis tech, SaaS, hardware, software, and that's why it's important for us within Kretsu to really, divide up and make sure our companies are talking to the right set of expertise. Some of it does cross over, but in terms of those key KPIs, it's very different market the companies are operating in. And life science is definitely a little more organized of a market. The CEOs generally seem to have a better sense for where they are in the curve, and it's very data-driven versus sales and marketing-driven, which can be a little bit more variable. So the exit potentiality and certainty in life science has been pretty good lately. A number of our best companies are in life science looking for big exits next year. So it is a great year. And so thanks for the final question there. We'll go ahead and wrap up and conclude our discussion. Thanks, everybody, for being here. We'll be doing this monthly. So please do tune back, and we appreciate everybody being with us. If you'd like a copy of any of the information today, please reach out to Max or myself.